Welcome back, dear learners. Before the ad break, we were able to record lending buildings as well as vehicles into note number 3. Now, what we have here is information that relates to equipment, and it reads, some balances on the 1st of July. This is the beginning of the financial year. Then we have equipment as well as its accumulated depreciation. The following transactions involving tangible assets took place. The business bought computers and printers, 28,000. So this becomes our new. The installation cost of 2,000 was paid by EFT, all right? And then depreciation is written off on equipment at 10% per annum on the diminishing balance method. We want to see now, how do we record this in our tangible asset note? At the beginning, we had 56,000 worth of equipment. There it is. And our accumulated depreciation was 5,600. There it is. You have to remember that accumulated depreciation is subtracted from your cost to get your carrying value. So you say 50 minus 5.6 to get 50,400. When we come to the additions then, you have to remember that the business bought computers and printers for the office, 28,000. But we paid 2,000 for their installation. So when we come to our additions, it becomes 30,000 then. How do we get 30? It is the 28,028. It is the 28,000 that we have paid, plus the 2,000 for the installation. That is how we get this 30,000. When we calculate depreciation, you have to remember that now we have the old equipment, which is your 56,000. And we also have the new equipment. And the new equipment is for 30,000. So we have two pieces of equipment. Depreciation is written off on equipment at 10% per annum on the diminishing balance method. That means we calculate depreciation on the carrying value. So we'll say the cost, 56, minus the accumulated of 5.6. It gives us the carrying value of 50,400. I would have just taken it from here. So I'll come here. I have my 50,400. And I'll say multiplied by 10 over 100, that is 10%. And the old, we had it for 12 over 12. We had it for 12 months. Therefore, my depreciation for this financial year would therefore become 5,040. 5,040. There is my depreciation, 5,040. For the new one then, the new one does not have accumulated depreciation. Why? Because it is new. We just acquired it this year. So it was not there in the previous years. Remember, accumulated depreciation is the depreciation for the previous years. So this is new. It will not have accumulated depreciation because it was not there in the previous years. So take the 30,000. Then we say multiply that by 10 over 100. We now need to know for how many months we had this new one. We had it from the 1st of March. So if we had it from the 1st of March, we'll count now. Remember, our financial year begins on the 1st of July and it must end in June. Okay, and we had this from the 1st of March. So we're counting from March, April, May, then June. So that means we had it for 1, 2, 3, 4. We had it for 4 months. Now, grab your calculator. You should be able to say 30,000, punch that in your calculator, multiply that by 10%, and then you multiply that by 4 over 12. That will then give you 1,000. That will give you 1,000. So I have two depreciation amounts. I have 5,040. I also have 1,000. So when I come here on depreciation, I'm now adding my 5,040 plus my 1,000. That gives me 6,040. In there, it is depreciation for the old and depreciation for the new. Okay, let's go further down then. My cost then changes. How does my cost change? Because I have additions here. So I have 56 plus 30. That gives me 86,000. My accumulated depreciation therefore is my 5,600 plus my 6,040. All right, that gives me 11,640. For me to get the carrying value at the end of the year, I then say my cost 86,000 minus my accumulated depreciation 11,640. That gives me my carrying value of 74,360. It is very important, dear learners, that when we do these calculations, we remember that we have the old, but we also have the new. And when we do our depreciation calculations, remember the old will be there for 12 months, but the new one, we start counting from the time we have acquired it until the end of the financial period. When we look at financial investments, we'll be talking about our fixed deposits. So we have a fixed deposit from AB Bank, and it is 60,000. On additional information, we are told part of the fixed deposit at AB Bank matures on 30 June, that is in the next financial year. Remember, our financial year is ending on the 31st of December. So when we're on 31 December, in the next few months, on the 30th of June, in the next financial year, that is when part of the fixed deposit will mature. Now, you have to understand that when a fixed deposit is going to mature within the next 12 months, it ceases to be a non-current asset and then it becomes a current asset. So we'll come here and then we'll say our financial assets are 60,000, which is this one there. And then we subtract the amount or the part of the fixed deposit, which is set to mature within the next 12 months. Therefore, we remain here with 35,000. And that 25,000 will now go to your cash and cash equivalents. That is your note number 6. When you are done with the preparation of your note number 3, you will need to transfer the amounts to your statement of financial position. Remember, we've already done the financial asset where we had 60,000 of the fixed deposit. 25,000 is set to mature within the next 12 months. Therefore, we remain with 35. Then, you will now take your carrying value. This is what you then go and record under your non-current assets. So you say 290,000 plus 275,000 plus 74,360. It would then give you 639,360. Once you have this, you then add the two, 639,360 plus the 35,000, that gives you 674,360. That becomes your non-current assets. Dear learners, thank you so much for joining me in today's class. I hope to see you again very soon. It is goodbye.